Benjamin Graham is widely considered the father of value investing, a strategy that has stood the test of time. His seminal book, The Intelligent Investor, is a timeless guide that has influenced countless investors. It teaches readers how to build wealth safely and steadily in the stock market, avoiding the pitfalls of speculation. Graham believed in buying stocks when they are undervalued, a principle that remains relevant today. He often compared this approach to buying a dollar for 50 cents, emphasizing the importance of value. This book is not about getting rich quick or chasing the latest market trends. Instead, it's about making smart, informed decisions over the long term, ensuring steady growth. Central to Graham's philosophy is the concept of intrinsic value, which he believed was the true worth of a business. This intrinsic value is determined by a company's assets, earnings, and potential for future growth. By focusing on these fundamentals, investors can make more informed decisions. Intelligent investors look for stocks trading below their intrinsic value, seeing them as opportunities. They buy these undervalued stocks and hold them patiently, waiting for the market to recognize their true worth. This patient approach allows the market to eventually recognize and correct the stock's value over time. The intelligent investor also emphasizes the importance of temperament in investing, a crucial but often overlooked aspect. Emotions can lead to poor decisions, causing investors to act irrationally. Fear and greed are powerful forces that can cause investors to buy high and sell low, leading to losses. Graham stresses the need for discipline and patience, urging investors to stay the course. He encourages investors to stick to their strategies even during periods of market volatility and uncertainty. This book is not just for financial experts or seasoned investors. It's written for everyday people who want to take control of their financial future and make informed decisions. Graham uses clear, accessible language and practical examples to illustrate his points. He provides a solid framework for making sound investment decisions that can withstand the test of time. These timeless principles have helped countless investors achieve long-term success and financial stability. One of the most important concepts in The Intelligent Investor is the difference between investing and speculation. This distinction is not just academic, it has real-world implications for anyone looking to grow their wealth. Graham draws a clear line between these two approaches, emphasizing their fundamental differences. Understanding this distinction is crucial for long-term success in the stock market. It can mean the difference between steady growth and significant losses. Investing, according to Graham, involves thoroughly analyzing a company. This means diving deep into its financial statements and understanding its business model. You need to understand its business, management, and financial health. This comprehensive analysis helps in making informed decisions. Investors look for companies with strong fundamentals. These are companies that have a solid track record and a promising future. These companies are expected to generate profits over the long haul. They have a sustainable business model that can weather economic downturns. They are purchased with a margin of safety. This means buying stocks at a price that is significantly lower than their intrinsic value. This means buying them at a price significantly below their intrinsic value. This approach minimizes risk and maximizes potential returns. Speculation, on the other hand, is based on short-term market fluctuations. Speculators are more concerned with market timing than with the underlying value of the stocks. Speculators focus on timing the market. They try to buy low and sell high within short periods. They try to profit from short-term price swings. This approach is often driven by market sentiment and external factors. They often rely on rumors, tips, or technical analysis. This analysis looks at past price patterns to predict future movements. Graham cautions against speculation, warning that it is a risky endeavor. He argues that it is essentially gambling. Unlike investing, speculation offers no real control over your investment outcomes. The market's unpredictability can lead to significant losses. While speculators may enjoy occasional wins, their approach is inherently risky. The odds are often stacked against them. It can lead to significant losses, especially over the long term. The volatility of the market can wipe out gains quickly. The intelligent investor advocates for a disciplined, long-term approach to investing. This strategy is less about quick wins and more about steady growth. It emphasizes fundamental analysis and a focus on intrinsic value. This methodical approach helps in identifying truly valuable investments. This strategy, Graham argues, provides a more reliable path to building wealth. It is a time-tested approach that has proven successful for many investors. It helps investors avoid the pitfalls of speculation. By focusing on long-term value, investors can achieve more stable and predictable returns. Inflation is a hidden threat to investors, often lurking in the background. It erodes the purchasing power of money over time, making each dollar less valuable. What you could buy with a dollar today might cost significantly more in the future due to inflation. This is why it's crucial for investors to consider inflation when making investment decisions, as it can impact returns. The intelligent investor acknowledges the impact of inflation on investment strategies. Graham emphasizes the importance of preserving purchasing power to maintain wealth. He suggests that investors consider assets that have historically acted as hedges against inflation, such as stocks and real estate. These assets include stocks, which represent ownership in businesses, and real estate. Stocks can benefit from inflation, as companies often raise prices in response to rising costs. This ability to adjust prices helps companies maintain their profitability even during inflationary periods. Maintaining profitability is key for businesses to thrive in an inflationary environment. Real estate, being a tangible asset, can also appreciate in value during inflationary periods, providing a hedge. However, Graham cautions against simply buying any stocks or real estate without thorough research. He stresses the importance of selecting investments carefully, focusing on quality and potential. Look for companies with strong pricing power and the ability to pass on increased costs to consumers. These companies can better withstand inflationary pressures and protect their margins. Also, consider real estate in desirable locations, as these areas are likely to experience price appreciation. Properties in prime locations tend to hold their value and even grow during inflation. Understanding inflation is crucial for long-term investment success and wealth preservation. The intelligent investor encourages investors to be mindful of this silent thief that can erode wealth. They need to make informed decisions to protect and grow their wealth over time, ensuring financial stability. Pause 3s. One of the most critical concepts in Benjamin Graham's philosophy is the margin of safety. This principle is the bedrock of value investing and serves as a protective measure against errors in judgment and unforeseen market downturns. Essentially, the margin of safety is the difference between a stock's intrinsic value and its market price. By purchasing stocks when they are significantly undervalued, investors create a buffer that can absorb potential losses. This buffer is crucial in reducing risk and ensuring a higher probability of earning satisfactory returns. Pause 2s. Graham believed that no matter how thorough one's research and analysis might be, there is always an element of uncertainty in investing. Market fluctuations, economic changes, and company-specific issues can all impact the performance of an investment. The margin of safety acts as a cushion, providing a safeguard against these uncertainties. It allows investors to withstand market volatility without being forced to sell their holdings at a loss. Pause 2s. To illustrate, imagine investing in a company whose intrinsic value is estimated at $100 per share, but the current market price is only $70. This $30 difference represents the margin of safety. By buying at this lower price, you are effectively paying less for each dollar of intrinsic value, thus reducing the risk of loss. This approach requires patience and discipline, as it often means waiting for the right opportunities to arise. Pause 2s. The margin of safety is not just about buying low, it's also about ensuring quality. Graham emphasized that investors should seek out companies with strong financials, competent management, and a solid business model. These factors contribute to the intrinsic value and provide additional layers of safety. Pause 2s. In conclusion, the margin of safety is a fundamental concept that helps investors navigate the uncertainties of the market. By focusing on undervalued stocks and maintaining a disciplined approach, investors can protect their capital and achieve long-term financial success. The intelligent investor encourages us to always keep this principle in mind, ensuring that our investments are both prudent and profitable. Pause 3s. Another pivotal concept introduced by Benjamin Graham is the allegory of Mr. Market. Mr. Market represents the often irrational behavior of the stock market, characterized by its frequent fluctuations and emotional reactions. Graham personified the market as a moody individual who offers to buy or sell stocks at different prices every day. Sometimes Mr. Market is euphoric, driving prices up, while other times he is pessimistic, causing prices to plummet. Pause 2s. This metaphor serves to remind investors that market prices are not always reflective of a company's true value. Instead, they are influenced by various factors, including investor sentiment, economic news, and short-term events. By understanding Mr. Market's behavior, investors can take advantage of these fluctuations rather than being swayed by them. Pause 2s. For instance, when Mr. Market is overly pessimistic and stock prices are low, it may present a buying opportunity for value investors. Conversely, when Mr. Market is overly optimistic and prices are inflated, it might be a good time to sell or hold off on new investments. The key is to remain rational and not let Mr. Market's mood swings dictate your investment decisions. Pause 2s. Graham's teaching encourages investors to focus on the intrinsic value of their investments rather than the daily price movements. By doing so, they can maintain a long-term perspective and avoid the pitfalls of emotional investing. Pause 2s. In conclusion, the concept of Mr. Market is a valuable tool for understanding the nature of market fluctuations. By recognizing the emotional and often irrational behavior of the market, investors can make more informed and disciplined decisions. The intelligent investor urges us to see beyond the market's noise and remain steadfast in our investment strategy, ensuring that we capitalize on opportunities while minimizing risks. Pause 2s. Pause 3s. Now that we've explored the concept of Mr. Market, let's delve into another crucial aspect of investing: the choice between stocks and bonds. Pause 2s. Investments can broadly be categorized into two main types: equities, commonly known as stocks, and fixed income securities, referred to as bonds. Each has its own set of characteristics, risks, and benefits. Pause 2s. Stocks represent ownership in a company. When you buy a stock, you become a partial owner of that business, entitling you to a share of its profits through dividends and capital appreciation. Stocks have the potential for higher returns compared to bonds, but they also come with higher volatility and risk. Pause 2s. On the other hand, bonds are essentially loans you give to corporations or governments in exchange for periodic interest payments and the return of the bond's face value at maturity. Bonds are generally considered safer than stocks, providing more stable and predictable income. However, they typically offer lower returns. Pause 2s. The choice between stocks and bonds depends on various factors, including your investment goals, risk tolerance, and time horizon. Younger investors with a longer time horizon might prefer stocks for their growth potential, while older investors nearing retirement might lean towards bonds for their stability and income. Pause 2s. Diversification is key to a balanced investment portfolio. By holding a mix of stocks and bonds, investors can reduce risk while still capturing growth opportunities. This balance can be adjusted over time to align with changing financial goals and market conditions. Pause 2s. In summary, understanding the differences between stocks and bonds is essential for making informed investment decisions. Both asset classes have their unique advantages and can play a vital role in achieving a well-rounded and resilient portfolio. Pause 2s. The intelligent investor teaches us that a disciplined approach, coupled with a clear understanding of our investments, can help us navigate the complexities of the financial markets and achieve long-term success. Pause 2s.